Hi friends, welcome to Trade Advisor's third video on technical analysis. In second video of this series, I explained about the trend and trend lines and its uses. Henceforth, I will discuss about indicators used for technical analysis. Use of technical indicators in the technical analysis of stocks is beyond any doubt. Technical indicator is a series of data points which are calculated by using a formula to price data of the stock. The prices include open, high, low, and close prices. Some indicators use only close price, and the others use all other prices. The indicators are also made by using information like volume and open interest, etc. For the purpose of analysis, the indicators are shown in the graphical form. Some indicators are overlaid on the price chart of the stock. Many indicators are shown below or above the price chart. The indicators enable us to analyze the price action objectively. Indicators help us to understand the hidden information of the future price movement. By using indicators, we can generate the buy and sell signals for the security. As discussed in the first video, the signals are not correct all the time, but the probability of signals being correct increases beyond 80% with indicators. There are many indicators and new indicators are frequently invented. One must use those indicators which give better buy and sell signals and are effective and easy to interpret. One of the most important things is the selection of the period for the indicator. If the period selected is smaller, then there are more chances of false signals. If the period selected is larger, then the signals are very late and the profits become less. Some indicators oscillate between two limits, like 0 to 100. These are called as banded indicators. Some of them oscillate below and above the zero line. These are called as centered oscillators. The indicators, which give the signals earlier, are called as leading indicators, and those giving signals later are called as lagging indicators. In next few videos, we will learn about indicators like moving average, relative strength index, moving average convergence divergence, stochastic, money flow index, directional index, Bollinger Bands, etc. In this video, I will explain about the use of moving averages. Moving average is used to provide objective picture of the trend direction by smoothing the price data. The daily variations are smoothened out by calculating averages. Averages are calculated by using closing prices. Three kinds of averages are used: simple moving average, exponential moving average, and weighted moving average. Most traders use simple moving average and exponential moving average. Exponential moving averages are found to be more satisfactory. One of the important parameters is the period of moving average. This is selected as per the time frame of trade or investment. Shorter the time of the trade, shorter will be the period used. The shorter period is more sensitive and may result in more whipsaws, means wrong signals. The longer period gives better idea of the big trend. Trading signals are generated by crossing of price and moving average, or the crossing of more than one moving averages. Let us understand buy-sell signals if only one moving average is used. In this case, the signals are generated when the price crosses above or below the moving average. In this slide, at the letter A, the price of the stock crosses the line of moving average from below, and for 2 to 3 consecutive candles, it closes above the moving average. This gives buy signal. Here, the stock or the future can be bought. At the letter B, the price of the stock crosses the line of moving average from above, and for 2 to 3 consecutive candles, it closes below the moving average. This gives sell signal. Here, the stock or the future can be sold. For confirmation of the change in trend, investors may wait for 2 to 3 candles closing above moving average for the buy signal, and closing below moving average for the sell signal. Let us now understand buy-sell signals if two moving averages are used. Buy signal is generated when fast moving average of small period crosses above the slow moving average of the larger period. Sell signal is generated when fast moving average of small period crosses below the slow moving average of the larger period. In this slide, at the letter A, the red-colored fast moving average crosses the green-colored slow moving average from below and moves above it. This gives buy signal. Here, the stock or the future can be bought. At the letter B, fast moving average crosses the slow moving average, from above, and moves below it. This gives sell signal. Here, the stock or the future can be sold. For confirmation of the change in trend, investors may wait for 2 to 3 candles closing above the moving average for the buy signal and closing below moving average for the sell signal. Now, let us understand the buy and sell signals with the help of 3 moving averages. In this slide you can see that the fast moving average crosses the green medium moving average from below. This generates first buy signal. Then the fast moving average crosses above the slow moving average in blue color. This confirms the previous buy signal. Later, the medium moving average crosses the slow moving average, which confirms previous 2 signals. Thus, the crossing of fast, medium, and slow moving averages in upward direction generates the buy signals. Similarly, if the moving averages cross each other on downside, then the sell signals are generated. If the slopes of moving averages while crossing is higher, then the change in stock price will be quicker. If the slopes of moving averages while crossing is flatter, then the rise in stock price will be slow. There are 2 very important points about the crossing of 3 moving averages, which give more accurate signals. If all 3 moving averages meet in one point and move upwards, then very strong buy signal is generated. If all 3 moving averages meet in one point and move downward, then strong sell signal is generated. Secondly, if fast moving average comes near slow moving average, but without crossing, it again turns in its previous trend's direction, then it confirms strong up or downtrend, as the case may be. In this slide, you can observe 3 moving averages meeting in one point and moving in the upward direction, resulting in strong buy signal. In the same slide, you can see the fast moving average coming near slow moving average and turning upward without crossing, and subsequent rise in the stock price. In this slide, you can observe the moving averages meeting in one point and moving in the downward direction, resulting in strong sell signal. In the same slide, you can see the fast moving average coming near slow moving average and turning downward without crossing and subsequent fall in the stock price. There are higher incidences of averages meeting in one point, in case of 5, 13 and 26 period moving averages, in any time frame. The conservative investors can use filters to confirm the up or down trend. One of the confirmations may be 1 to 3 candles closing above or below moving average. Second confirmation may be a full candle or 2 candles appearing above or below moving average. The third confirmation may be the moving average turning in the direction of the price trend. The moving average periods used for short, medium and long-term investments are written on this slide. One can use 2 or more moving averages at a time or even pairs of moving averages to get buy and sell signals. Friends, I am sure that you must have understood trading with moving averages. I will conclude with a request to share and subscribe to this video and channel. Thank you.